I think we need to start with kind of a level setting about ESOPs. And so I'm going to start by asking Gail the simple question of what on earth is an ESOP? Let's start there.
Let's start there. And it seems that it would be a simple question. ESOPs were first developed actually in 1956, believe it or not. And you'd think that by now we'd have all the answers. And I think with Chris and Carrie, you'll be able to hear pretty much all the answers about ESOPs today. But they've been around obviously then for a long time. They've since their establishment, they've been supported by legislation that directly encourages companies to and owners to establish ESOPs for the benefit of employees, with a view that from a policy perspective, it's very beneficial to have employee ownership of their companies. They're considered a defined contribution plan, like a 401k or profit sharing plan, in which the primary investment is employer stock. So they provide income to employees post termination and retirement, and they provide significant tax benefits to their sponsors. So that's a nutshell.
So one of the interesting things about it, of course, is that employees, while we always talk about it as employee ownership, technically the plan is the owner of the company and the employees are participants in a plan.
Right, that's right.
I wanted to, as we were getting started in here, like, so of the, right now in 2021, which is the last year for which there's data, there are about 6,300 ESOPs across the country. And those have over 10 million active participants and maybe another 4 million retirees that participate in the plans. And in total, over 2 trillion in retirement assets are available in all of those. So it really is a pretty powerful force. Most of them are private companies, over 90%, but some public companies have ESOPs as part of their structure. And they really vary in size. 57% are under 100 employees. There's another 33% that are between 100 and 1,000 employees. And then 10% have over 1,000 employees. So broad range of sizes, broad range of industries, right? We had 20% manufacturing, 19% professional and technical services, 15% in construction, 15% in wholesale and retail trade, 14% in finance, insurance, and real estate, and then the rest are others. But some of the biggest ones, right, if you go to the top 100 ESOPs in the country, a lot of them are engineering firms and retail supermarkets. So some of the biggest names are in those sectors. And then about 2/3 are structured as S Corps, right, which provide a lot of the tax benefits that I'm sure we'll get into here. And about 2/3 are leveraged. So those are the kind of the lay of the land in terms of what ESOPs are. And so I wanted to turn now to Kerry with his expertise in helping owners transition their companies. Why would a business owner, when thinking about an exit, why should they consider an ESOP?
Sure. Well, it's, in my opinion, it's one of the best ways to transition or exit a business. Not everyone should do an ESOP, but it should be at least put on the menu, like I said in opening comments. A lot of times when business owners are just trying to explore their options, a lot of times they're introduced to an M&A firm. And that M&A firm may talk about, a strategic sale or bringing in a private equity investment or auctioning the company. There's a number of different ways that you can, or going public. Again, a number of different ways you can transition or exit a business. But a lot of times those M&A firms do not establish ESOPs. They don't understand ESOPs or the 1042 component that goes along with them. So it's simply just not put on the menu. So for a lot of business owners, it's like going out to eat at a restaurant and, yeah, there's a burger, there's a fish sandwich, a salad, a taco, but there's no pizza. And if they knew pizza exists, I mean, pizza's pretty good. They may order pizza if they actually knew that pizza existed. So, but for an owner, what we find is when it is put on the menu, a lot of times owners are like, why didn't anybody ever talk to me about this? I had no idea, or I've heard about an ESOP, but this is not what I heard. This is a lot different. So there's a lot of times owners will say, this checks a lot of the boxes that I was looking, in a transition. And for an ESOP, a lot of times you can sell to an ESOP and you can achieve fair market value and your price. A lot of times it's beneficial to the employees. A lot of these business owners, a lot of them say, hey, the employees are the ones that got us here. And, there could be risk to the employees with other types of sales. So it does check a lot of the boxes. In our opinion, a lot more folks should be doing ESOPs, but not everybody.
And so on that front, well, let's stay with that. So you think they can achieve fair market value generally, that the transaction has to happen at a fair market value. It's got the potential for keeping employment for people you care about.
Yes.
And you mentioned earlier that it can be very tax efficient. So do you want to touch just on the tax efficiency of it for a moment?
Sure. So as Gail said, I mean, at the end of the day, an ESOP is an ERISA qualified plan. And so we're really creating the buyer. We can guarantee that we can sell the company because we're creating the buyer for the selling owners. And then with that, Congress has allowed all kinds of tax benefits to go along with ESOPs. Really, at the end of the day, what we're doing is converting cash flows from taxable. You're converting the company into, in some cases fully or in some cases partially tax-free, and you're using those tax savings to buy out the selling owners. So there's all kinds of tax benefits to the company itself when you become an ESOP company. And then for the selling owners, there's a section, most of the folks on this call have heard of 1035, or excuse me, 1031 exchanges in real estate, or 1035 in the insurance world. In the ESOP world, for the selling owners, now understand the owners of these companies, they own their stock individually or in joint tenancy with their spouse or in a trust, but they're choosing individually to sell their stock into the ESOP. There's a component of the tax code 1042 for the selling owner, and it is an individual election. If they choose to do so, the proceeds that they receive from the sale of their stock into the ESOP, they can execute 1042, and it's a permanent deferral of the capital gains on the sale of their stock into the ESOP. So for the company, there's all kinds of tax benefits. For the individual sellers, there's tax benefits.
And if we go deeper on that question, we will get so technical that I will go to sleep. So we won't do that right now, but those are two powerful forces for both a selling owner and for a future company structure. Is there anyone, Gail, maybe you could touch on, are there businesses that shouldn't consider employee ownership as an option?
There are certainly, and I know Carrie can speak to some of this too. If your earnings are too volatile or unpredictable, then you're going to have a difficult time convincing a lender to support a leveraged ESOP arrangement, because really they have to be able to predict, obviously, the ability to repay the loan from the earnings of the company. And that's why, as you said, Chris, you see it so often with the engineering firms, with the grocery and retail, the areas where there's a very predictable, steady line of income. Those are the types of businesses that work beautifully for an ESOP. Also, if you don't have management continuity, I mean, if you're the owner, and you maybe often an owner founder and selling your company back to a trust that holds it for the benefit of the employees, you want to be sure that you've got management that'll continue to run the company, and because you're not going to have someone swooping in to provide that level of support that you would if you had a third-party sale. If you have significant capital needs for the company, that can sometimes be a problem where an ESOP isn't ideal. And also if you're a capital intensive company where a lot of the value is based on capital rather than having a broad employee base, it might not support enough contributions to an ESOP to fund the purchase of the shares. Those are just a few. And Carrie, I'd be interested in your thoughts too on other areas.
No, I think you're spot on. I mean, you have to have succession to be able to do an ESOP. If you're looking to sell and you want out right now, and you don't have a runway of ahead of you, I mean, you want all your money, you want it right now, and you want to be done. That's not an ESOP. So you have to have succession. You're gonna get some money at closing potentially, and then get paid out over time. And then also you have to have some level of sophistication at the operating at the business level. There are companies that I mean, look, you can have $1 million in EBITDA and a handful of employees and some succession, and you can check the boxes that yes, we could do an ESOP, and you could even make financial sense out of it. But it may be the worst thing that you've done, because now if you've installed this ESOP for a company that really has, I mean, they're a great company. They may be 10, 20 million in revenue. They have a bookkeeper on staff, but they may not be able to survive the transaction. They may not have the sophistication or the time available to make the transaction successful. So that even though they might be able to do it, it may not make sense for them. They may be too small.
And that's really the level of compliance, documentation, right? The precision with which you have to operate your business is a lot higher in an ESOP. And when we were talking ahead of time, Carrie, I think you had a rule of thumb in terms of how much EBITDA somebody really needed to maybe have the sophistication in their organization to make it work.
Yeah, and that really is $1 million in EBITDA, or if they had 800 and they have add backs to get to that million or over, then financially, does the transaction make sense? Yes, you could make sense of it financially for them to do that. However, for a lot of companies of that size, we'll look at the company. We may decline to actually install an ESOP for them because we see that they could potentially fail because they can't handle the transaction. However, there are plenty of organizations out there that they could hire to bolt on to help bring that sophistication. And if they're willing to do that, then we can proceed. We just don't want to ever set somebody up for failure.
And one way to do that actually is to sell to an ESOP, right? To a pre-existing ESOP where you share the ESOP infrastructure together. So let's transition a second. So we've talked about owners and we've talked about existing ESOPs. Let's talk about the benefits to employees from being in an ESOP. What I guess from my perspective, having served on ESOP boards and just looking at the statistics, there's a lot of benefits from both employee engagement being better within an ESOP structure. I think in the most recent study in 2023 that the National Center for Employee Ownership did, voluntary quit rates were about a third of what there was on the national average. Right. So you get tenure, you get continuity of employment, you get passion and engagement. And then the benefits from being from actually participating in it as a retirement plan, the retirement assets, when they looked at S Corp ESOPs and this was in 2023, employee owners had more than double the retirement savings compared to their non-ESOP counterparts. So on average, 80,000 compared to 30,000 in their retirement plans. So those are pretty significant benefits to the employee of being a part of that, being part of an ESOP. So what do you guys see when you're looking at ESOPs as the benefits to the employees? Anything you'd like to add?
Sure, Gail, do you want to go first?
Well, I'll go first and then turn to you. I think you've hit it well, Chris. I think it shows that level of engagement that is just enhanced when you have the employee ownership. You have really the most pure form of pay for performance, right? That the whole organization is benefiting from the efforts of the whole participating workforce.
Yeah, and we started out talking about all the benefits to the selling owners and the company and all that. But for the employees, this is a life changer. They would never, ever accumulate the amount of wealth that they will in these plans. For everybody on this call, you can afterwards just Google Forbes Tale of Two Sisters. It's an article that Forbes and NCO has about two sisters that were both checkers at grocery stores. Winco Foods had a policy where they couldn't hire, two family members. So one sister got hired out at Winco, which is an ESOP company, and the other at one that was not an ESOP company. Fast forward, as you'll read in the article, 20 years later, the one sister that was part of an ESOP company had over $1 million in her ESOP balance. The sister that was not had about 30,000 in her 401k. That's a game changer, has a significant difference. So for the employees that are participants and owners in these companies, it's a life changer.
And we've got a couple questions on this, both about, are there tax benefits to the employees in this? Because we talked about the tax benefits to the other constituents. And then also, so when can the employee liquidate their ownership, right? So when do they actually realize some of that ownership? So one of you want to tackle that?
I mean, I can speak to it a little bit, and then Carrie can chime in. I think that tax benefits, that's an easy one. It's just like any other, largely like any other qualified plan. You've got deferral of taxation on the benefits in that trust. So until the funds are distributed, you're not going to be taxed on the value. So that's of course huge. This is now just talking about to the employee, the benefits, and then the distributions. I think in some ways that goes to some of the downsides to an employee of these kind of arrangements, because the values are there, as Carrie said, but they can be less accessible in an ESOP to employees than they would be to employees in a 401k or profit sharing plan, for example, that people are generally very familiar with. There can be payouts can be deferred, retirement, death, and disability. The year after termination, they can, is the earliest they're required to be paid out. So that can postpone it quite a bit. And then if it's just a regular termination, those distributions can be postponed for 5 years and then paid over a series of years, depending on the value of the benefit. So, and if the plan's leveraged, then the plan can defer distributions until the loan is repaid. So the accessibility to that value can be a perceived limitation. It also can be one of the things that gives it the ability to compound so powerfully. But Carrie, what do you think?
I agree with everything you said, Gail, but just maybe a little different twist on it. I agree with you. It's just like a 401k, right? So but one of the things that I think is important to point out, because a lot of times people, when they're learning about ESOPs, they say, okay, and then so the employees are contributing and buying in. It's like, no. They don't pay anything. So they're getting, every time those owners are getting paid off, those shares are getting allocated to the employees for zero. So the employees pay nothing. They get these balances that are contributing. And then, as Gail said, then it's going to compound on a tax deferred basis. And so, yeah, there's going to be a time where it comes time to distribute the money out, and then it's ordinary income, just like in a 401k. But they do get all this free money that gets to compound for a number of years. Make no mistake, these ESOPs are geared to benefit long-term employees, and long-term employees are going to reap huge benefits. One of the things Gail mentioned, which is critical too, about accessibility. Look, humans are humans, and if you have some 32-year-old that all at once gets an annual benefit statement and sees that, oh wow, I have $100,000 in my ESOP account. I'm a little tired, and I got plenty of time to go back to work. You know what, Mr. Owner, thank you very much. I think I'll take a break and I'll come back later. So give me my 100,000. Well, now the owner can go to that, and we call that calling in rich. And so you want to design it so they can't call in rich, and because then that hurts them. It hurts the company, hurts them. So they have these distribution policies to protect them from themselves. Say they have to wait 5 years and to get paid out over 5 years. Now that 32-year-old may say, oh, never mind. It's okay, I'll wait. So again, this is to benefit long-term employees.
And I know, Gail, when we had talked in the prep call, you had talked about the risk from employees having all of their wealth then tied up in the same place where they're being employed, right? So their retirement assets are in with the company, their compensation's coming from the company.
Right.
But so can you talk about some of the structural diversification that's required in order to allow people to mitigate the risk?
Mitigating that risk. Yeah, it is a risk. Of course, it's a risk many, of course, directors are familiar with the C-suite of having so much of their income riding on the performance of the company or the equity values. And now you're talking about really putting that scheme in place in a way that impacts all your employee workforce. So their job is dependent on this company, their retirement security is dependent on this company. That can be, as you say, a lot of eggs in one basket. And because of that, there is a diversification requirement that the ESOPs have to have, but it applies to those who have 10 years of plan participation and are age 55 and older. And then you can diversify over time, 25% a year. At age 60, I think it goes up to 50% a year. So there is a recognition that as these long service employees get closer to retirement, they need a sort of an off-ramp from that risk. And so that's built into the ESOP rules in a
And
way.
they can diversify that into another kind of IRA kind of program if they want to.
Right.
At that point.
Or just diversify the type, even holdings within the trust into a different form of investment.
Something that's not that. We've had a fair amount of questions that I would call are kind of for company partial ESOPs, right? If a company wants to create an ESOP within the company for as an employee benefit, even if the control is a public or a primary shareholder. Do you want to comment on that kind of strategy? The questions were amongst, could you create an ESOP versus giving phantom stock to someone? I think was one of the questions that came in. And how would could a company that's structured differently just have an ESOP as an employee stock ownership plan as a benefit within the benefit set?
Yeah, Carrie, do you?
Yeah, absolutely. I mean, yes, and we actually prefer to do partial ESOPs. You can always do another sale later on and sell the rest of it, but it's we'd rather see them break it up into segments and do a partial ESOP. So the answer is yes. Could you just sell part of the company? Yeah, you could. You have to at least, if the owners are interested in doing that 1042 thing we talked about earlier, they have to at least sell 30% in aggregate between owner or owners to qualify to do 1042. But yes, you could do a partial sale to an ESOP. And the owners are typically the chairman of the board, so that control thing comes into where they say, well, what happens if I sell part of my company? It's a big benefit, good retention and attraction tool for employees, and very powerful. But owners can still, because they control or chairman of the board or whatever, can still receive their salaries and maintain. Nothing has to change, just a nice benefit.
And I think one of the really interesting things about ESOPs is they are all different from each other, because however you write your plan, that's how your ESOP has to be governed. But there's a lot of flexibility in how you structure and write that plan at the beginning. So in addition to kind of advice for future directors of ESOPs, like it's really good to read the plan when you first join the ESOP board to understand what the real attributes, because unlike with public companies or other kinds of structures where it's more obvious and it's more standardized, with ESOPs, it's very different. So I guess I'd want Carrie to ask you to comment on what are some of the key structural things that happen when you're creating an ESOP that are either, you said to me as we were prepping, right, you want to get it structured right the first time. And what do you think about when you're thinking about good structure?
When we talked about who should and shouldn't do an ESOP too, it's the structure is so important. I mean, you have to structure it, and it's not one size fits all. Let me give an analogy. Okay, everybody on this call today, right? All the men, you get a pair of jeans, and we're going to send everybody a pair of jeans in their size 32 in the waist. Ladies, everybody's getting a 16. Okay, well, you know what? There's probably a few of us, not me, but a few of you gentlemen that can fit in those 32s, and it's not one size fits all. It doesn't work, right? All these companies are different. The owners are different. There's different goals and objectives and different types of companies. So you don't just rubber stamp and say, this is an ESOP. It isn't a product that you're selling somebody. This is a customized solution, and that's how it should be done. It's not one size fits all. One of the things I don't like that I see in the ESOP community right now is that rubber stamp. The most common thing that you see is 100% sale, and then getting to an S corp as quick as you can with a recycled stock design and SARs and warrants, and it's just like the same thing over and over and over. And quite frankly, I don't think that's necessarily a great design. 100% debt on a company at 5 or 6 times is too much debt and can destroy a company. So it is so critical that as an ESOP, whoever the drafter, the designer is, really needs to sit down with these owners and ask them, who are you? Tell us about your business. What are you trying to accomplish here? And then there's all kinds of flexibility that can be built into the design of an ESOP. It's not one size fits all and a rubber stamp.
And I think based on your comment, right, if someone is actually, a seller is taking back a note for a large part of this, they actually care whether it's structured to survive or not, right? So making sure that the company is healthy on the other side in that structure. And I think there's things set out there. I've been on 2 ESOP corporate boards where the ways in which contributions were made into the plan was very, very different, right? It can be a percentage of the compensation can get allocated every year. It can be all of the profits get allocated every year, right? So there's a huge range of what's set up there at the beginning that really can either enable or constrain the company going forward. So.
Yeah, beware of the drafter too of these ESOPs, because anybody can go set up a ESOP consulting company, and at the end of the day, as Gail knows, it's an ERISA qualified plan, so all it is plan documents. Any CPA or attorney or somebody that wants to go set up one of these shops that is an ESOP designer, just beware, and because they may be able to give documents, but they may not be gifted in being able to design a good plan.
And before we go forward, I think there's one fundamental we didn't cover because a question just came in around this, which is the basic money flow in a transaction. So if you were let's just imagine for simplicity's sake, it's 100% ESOP, right? And the company wanted to sell. So how does the money actually flow when the ESOP is created? So if you could talk about how the leverage works and the repayment of the debt, and how the question is, how is it that the employees pay nothing? So can you do that, Carrie, for us?
Sure, I can. So with an ESOP, and let's just keep it simple. Let's just say it's a 100% sale, and somebody's selling $10 million into an ESOP. Okay, so you'd mentioned, Chris, leverage or unleveraged. So they can either go, if they want money at closing, they can go to a bank, and the banks will typically right now lend 2.5 times of EBITDA, and so they'll get some money at closing. On a 10 million right now, we're seeing maybe they'll get 2 or 3 million, maybe even 4 million at closing. So owner agrees to sell into the ESOP. Somebody creates the plan. The owners are selling their stock into the ESOP. They may get $3 million at closing, right? And then they get a seller note or an IOU for the remaining $7 million. When there's an ESOP trust that's established, and all the money is going to flow through that ESOP trust. So at closing, that $3 million will go in and then out of the trust. So there's an inside loan, there's an outside loan, but money goes into the trust and then out of the trust, and that's where it's washed of tax, if you will. But anything that flows through that trust, and the owners are getting paid their money, stock then gets allocated to the eligible participants, and they don't pay a penny for it, but it gets allocated to them. And then they'll see how many, they get an annual benefit statement, and they see how many shares they got allocated, what the current value is, and their total, right? And what their vesting amount is.
So it's like a
but
leveraged buyout in the sense that there's debt taken on, right? And in the future, as the company earns money, they repay that loan with the money that the company earns in the future. And as that, then the trust, instead of having debt, now has ownership in the shares and allocates them out to the employees. But if that's just a simpler way to think about it, right? The seller, the plan is in the middle, and it takes on debt to buy it from the owners. And then the company uses the cash to repay those loans. And as the company earns enough to repay the loans, right, that ownership can be allocated to the employees.
That's right.
Clear?
And you're talking about the leveraged. I mean, there's some owners that say, well, do I have to do a leveraged ESOP? Why do I have to have a bank involved? And the answer is no. They could sell or finance the whole transaction. They could take the whole note on themselves. And why would they do that? Well, instead of paying a bank interest, they could pay themselves the interest for carrying the note on the transaction. The only caveat to that is if they're doing 1042, they will need some money to be able to get through 1042.
So I want to just move, because there's a lot of, some of the complexity of this is as you get into the governance of that new structure. So I just want to take a minute to comment on who are the new people in your world, right? You go into a typical corporate board, right? And you've got the board, and you've got the company, and maybe you've got the SEC, and you've got the shareholders out there, and you've got employees. But in the ESOP world, first of all, the employees aren't just employees, right? They're owners, but they're really participants in a plan that is the 100% owner of the company, right? So they've got different roles now. The ESOP itself, the ESOP trust, is responsible to the participants 100%, right? Their interest as a shareholder in the company is for the benefit of the participants. That trust has trustees, right? So now you have another group beyond the board who are the trustees of the trust that you need to deal with. And those usually have the fiduciary obligation, right, associated with ERISA. You may have other owners. We talked about partial ESOPs. So there may be other owners than other shareholders other than the ESOP. The executives themselves are now employees and executives. And often on ESOPs, there's a fair number of internal board members. So they may also be board members. They may also be appointed trustees, right? So you have management can have a lot of different hats to wear. And the board of directors, an interesting circularity is usually the board of directors is appointing the trustees, and the trustees are electing the board of directors. So in the world of clarity or independence as a concept on, say, a public board, when you get onto an ESOP board, there's a lot of potentially conflicting interests that I think everyone just needs to be mindful of as they go into this. So I just wanted to parse this discussion a little bit, and starting with the employees, Gail, maybe you could comment on what different rights do employees have in being employees within an ESOP as compared to what you would typically think of.
Sure. And I just wanted to build on your overall very good description of the kind of fiduciary responsibilities, and maybe we'll get into that a little bit more, but to say, because those are so significant, and expose the trustees and board members and other fiduciaries to, higher risk, really, frankly, that they'll be challenged, that you really want to look at your D&O fiduciary coverage, because it may have an ESOP exclusion, and you may need a rider. So So I just wanted to tie that back a little bit to the structure too, to make sure as you're setting these things up and putting them in place, that you take a look at the protections you have against the kind of risks you just outlined.
Yep.
And so, and I hope we have more time to get into those risks, because it's so important for board members and trustees to
I
understand.
will ask you about risks. We've got to.
I'm a lawyer. That's a.
And we can jump to it now, right? Because it is there are a number of risks that are of specific concern in an ESOP that if, and this is fine to jump into it now if you want to go there.
Oh, well, okay, because I've sort of teed that up a little bit. I think what you find is in an ESOP, they have all these benefits, and those are shouldn't overshadow the risks. I mean, the risks shouldn't overshadow the benefits, but there are risks that it's very process oriented, the requirements for an ESOP to fulfill your duties. So it shouldn't scare people to know that their responsibilities and they need to follow a process. But where you get in trouble is when an employee or the Department of Labor come in and think the process wasn't sufficient, and usually it's often based on a valuation question. Did you overpay as a trustee for the stock? Were the projections too rosy? Did you hire an appraiser that somehow had a conflict of interest in hiring? Did you just rubber stamp it? Did you not give them the true skinny on the company's prospects? And those are the kind of things that when they happen can really put both the trustees and potentially the members of the board in the crosshairs of a potential claim of breach of fiduciary duty. So those are.
And I just want to add on to your comment that the valuation, so every year within an ESOP context, right, you have to do
Yes.
a valuation of the stock,
Mhm.
right, as in terms of both, and that factors both into your financial statements, into the employees' balances, and it's used
Right.
everywhere. And it's
Uh-huh.
really critically important that that's done by an outside independent valuation expert.
Yes.
And
And
we're,
an ESOP, one that's familiar with ESOPs ideally, because that's its own area of
Yeah.
expertise.
and it doesn't just affect you at the time of the initial transaction.
Right.
Because at any particular, so I'll just do a hypothetical that might illustrate a point. Like, say your share price is going up year over year based on management is providing forecasts to the valuation house. They're incorporating those forecasts into the future. They're doing, they're looking at what's happening in the market to do that valuation. But a lot of it is based on management's opinion of the company. So you're in the company, the share price is going up. And maybe it's going up steadily up until the day when the CEO retires. And then maybe those projections were a little rosy.
Mm-hmm.
And a couple of years out, the share price is now doing the opposite, right? That's a point of vulnerability if the inputs into that valuation process were not good or were suspect in some way. So it's important at the beginning to have the fair market value assessment right, but it's also important every single year through the life of the ESOP.
Yeah, and Chris, those types of cases even have a name in ERISA circle, stock drop cases. The stock drop case, and that unfortunately you can be vulnerable to a stock drop case even if there was nothing wrong with your projections, but external factors came into play. So you do want to go back to the beginning, check your D&O and fiduciary coverage, because we haven't talked about it, but an independent trustee is often, and I'm sure Carrie can weigh in on this substantially, but having an independent professional trustee to serve in that role can be really a very worthwhile thing to consider, because it can help to shield the board members themselves. Carrie, I don't know if you wanted to weigh in on that.
100% agree. We counsel all of our clients that do ESOPs we encourage them to keep the trustee that was part of the transaction on board. They should have that independent trustee.
And just for the record, though, even though we just all gave that advice about independent or external trustees rather than internal trustees, still probably, depending on how you're categorized, if maybe up to half of ESOPs have internal trustees instead of external trustees. So it's another one of those things to look at as you go into thinking about being a director. How is it structured? What percentage of independent board members are there on the board? Is it majority independent? Is it majority inside? 80+% of ESOPs now have one outside director, but we've all been on boards where having one of anything isn't necessarily the best way to do it. So I do think there's a trend in improving governance across the board in ESOPs, like there is in many, in the rest of corporate America. So you see more and more independent, but I think that's a major factor to consider if you're thinking about joining an ESOP board, is what that governance structure is. We did have a question about compensation that I'll touch on just because I'm on that, about whether since directors aren't employees and would not necessarily own stock in this structure. I would say just from personal experience, it is possible for, I usually see some combination of fees and maybe some kind of phantom stock that tracks the valuation. So as the company gets better, the phantom stock appreciates in the same way it would in any other structure. So it is possible to, you don't have to be just a fee for service kind of board member. You can, people figure out a way to have directors participate in the growth of the company if that happens. One of the other, you talked about the valuation risk. I know there's, and we talked about the complexity and the sophistication, but compliance risk is fairly high here too, because of the different oversight bodies, right? You've got, in addition to, what you would think of as the SEC looking over your shoulder, now you have the IRS looking closely over your shoulder, as well as the Department of Labor looking over your shoulder. So I don't know, Carrie, if you want to comment on what in particular they're looking for when they're looking over your shoulder, or maybe Gail, from a legal perspective, you want to comment on that, because they are, certainly when I did my first ESOP board, there were things I was like, wait, I never had to look at that before.
Right.
Gail, you want to take that first, and I can jump in on the employee
yes,
side?
I can jump in first. The Department of Labor has an agency, the Employee Benefits Security Agency, that since almost 20 years now, they've had an ESOP national enforcement project. So that's their job, is to identify and correct violations of ERISA in connection with ESOP. So you definitely, and a lot of the litigation either is initiated by the Department of Labor, or they jump in when a employee has raised a potential violation. So you really do have, you're used, as a board member, you're used to shareholders looking over your shoulder, but here you have employees who may have a complaint and will raise it through the channels of potentially litigation. You have Department of Labor, you have the IRS, as you mentioned, questioning what positions you've taken potentially. So really you do have just sort of a wider audience judging your behavior as a board member. And Carrie, you want to weigh in on that?
Yeah, I think there's, the DOL and IRS is not people you want to have problems with. And so, the board should take it seriously. There's all kinds of shenanigans they could do, don't do them, follow the plan. And I think for the employee side, to keep the DOL out of there is good communication from a great rollout meeting and educating the employees on what has just happened and what this means to them. No, they're not owners that they can now set their schedule and I'm taking Fridays off and increasing my pay, but they are owners and that they get significant benefit as the better the company does, the better they do. So a lot of the, we haven't talked really about committees on the boards or anything, but a lot of times having the board, go to the employees and having the employees, we see a lot of ESOP companies where they have an ESOP committee on the employees' behalf. And so if they don't know what's going on, then it's in their mind to just make stuff up and say, well, I think, this is wrong. I don't like this. I don't like that. I don't like what the CEO's doing, and let me call the DOL. So just proper communication. And you know what? Some of the best ideas are going to come from the field and from the people that are out on the front lines. And when they know that they have a voice and that they can benefit. I'll give you a quick example of a company, an ESOP company. There was a hot sauce company, and they have the employees. They do an annual meeting, get all the employees and educate them on how the company's doing and everything. But they'd also ask the employees, for ideas. And in this one year, the hot sauce company had big market share, and they just kind of plateaued. They just couldn't grow anymore. They had big market share and all that, and so they're looking for ideas. And so the employees, owners in there, a little lady that's been with the company for a long time raises her hand and says, "I have an idea." They say, "What's that?" Increase the size of the hole. And they did. And profits went up, revenues went up by 30%. So communication, I think, is a big one.
Yeah.
I think that's really, I mean, the benefits of ownership and broad employee engagement, right? There's nothing that requires you to have an ESOP in order to do that. And it's so powerful. And I think so it's advice for kind of any kind of company looking at your employees to do it differently. But most of the ESOPs I've been close to will have even a quarterly employee meeting. And the questions you get when you frame it as an owner's meeting are different than when you frame it some other way, right? Because people are really asking questions at that strategic level about growth in the business, about investment in the business, about are the executives, using the assets of the company well from their perspective, and how could they do it differently? And they have rights to see as owners, right? Rights to understand the valuation, right?
Yes.
They vote on who's on the board, right? If you have pass through voting, they can vote on who you are as a board member. And I think that's all, but both the thing to be aware of from a risk perspective, as Gail was pointing out, and that you don't want them going to the DOL instead of to you, but a huge benefit to the company itself.
And Chris, I wanted to circle back to a question that you'd asked earlier that I don't think we've gotten to fully yet, which is what are the employees' rights? Which is certainly they have a right to receive the annual benefit statement you've already mentioned. They have a right to a summary annual report, which annually, as it indicates, that summarizes the Form 5500 that you're required to file with the government. They have a right to receive a summary plan description that should clearly outline the terms of the plan so they can look at that and review it and keep it, and it's important to keep it updated. That tends to be something that can fall through the cracks. For public companies, as you mentioned, you would pass through the voting rights. For private companies, you wouldn't necessarily pass through voting rights, although you are required to pass them through if it's a potential sale involving all or substantially all the assets of the business, or merger, dissolution, or liquidation. Then you do have to pass it through. But otherwise, it's that balance of keeping the employees engaged, informed, being as transparent as is beneficial, without creating the wrong impression that you've turned over all your governance to a group of employees acting together.
Yeah, and I think thank you for circling back to that question, because that was an important one to think about what they are. And some ESOPs might put a average employee, a typical employee, on the board. Ones I've been involved with have not. We often have, members of the executive team on the board, more than you might find at a public company. But it's, that's up to the individual structure. There are many ESOPs that have what I would consider as a kind of world-class governance board, where maybe only the CEO is on the board, right? And the rest are independent directors. I did want to touch on, and someone mentioned the different committees, just as we all think about governance, just wanted to touch on the different things that the committees have to think about. And we've said them in different ways through the conversation, but if you're on nom-gov, right, how are you thinking about independence, what your mix of inside outside directors are? How do people recuse themselves if they're interested in a decision? Who does CEO succession? Right. I was involved in an ESOP board where the prior CEO, bless his heart, particularly said we want to set up the governance so that the independent directors are the ones choosing the next CEO. So, but that's not always clear, right? Sometimes the outgoing CEO thinks they should, or the management teams thinks they should control it. So I think that's an important consideration. On audit, we talked already about valuation, right? And how the valuation is done and ensuring its independence because the valuation is the major, thing that's risk within your financial statements of misrepresentation, right? It's often the biggest risk is actually the valuation itself. So the audit has to cascade back into the valuation. On compensation, one of the things that I was not particularly mindful of, but the Department of Labor is very interested in within an ESOP world. If you think about the future, the earnings of the company and how those are allocated across the employee base, it's often done on a basis of salary. So if you carve some of those earnings off to provide stock appreciation rights or options to the executive team, that changes the mix of what's being allocated to each portion of the employee groups. So they're often looking at that mix of how much is going into the ESOP versus how much is coming out in SARs, appreciation rights or options, can draw attention from the Department of Labor if you're not paying attention to it. So it's just something that's not a typical thing you would have to watch for.
Or if they're abusive. ESOPs are already rich enough, and unfortunately some of them are designed with abusive amounts of SARs and warrants, and those are definitely yellow and red flags for the DOL and the IRS.
Absolutely. They'd love to see only 10% in kind of SARs and options. And then you get into questions of how do you really value options? And I'm not sure the DOL always looks at it appropriately in terms of the real value that's being carved off. But they'll look at it in the simplest way, which is an option and a share are equivalent, right? Which is also a bit, right? I mean, it can be a bit challenging. So I just wanted to put that on people's radar screens to have in their minds as they're thinking about roles you might take on a ESOP board. It's, we're about an hour in now, and if we've got more, Jane's been passing me some questions as we've been going along. Are we good on if folks have questions or places you'd particularly want us to go to? Feel free to add more questions. One piece we've not touched on that I just want to at least say for human interest is I was also involved in the board of a private equity backed company where the private equity firm gave 10% of the equity to the employees. And this was to your point at no charge, at not a trade-off of compensation. They just said, we want to see the benefits of employee engagement. And they did. It turned out it was KKR backed, and it was the largest exit in 30 years in KKR's history when we sold the company at the end. And the wealth created for the employees in that company was tremendous. It was based in a little tiny town in central Illinois, and essentially $800 million of wealth went into that, or $300 million of wealth went into that community, which is transformative for the community and the people who were doing it. So I think that I would just draw your attention to that. It's a movement called Ownership Works. And they've thought through ways that if you're running a company and you want to think about the benefits of employee ownership, and you're not really going to structure an ESOP or sell the company into it, it's another approach that I think is a very intriguing one, and certainly was very powerful in that context.
Since you brought up private equity, we are seeing more and more private equity firms exiting some of the positions in their portfolio via ESOPs because they figured out a lot of the benefits that you've mentioned, plus the economics are pretty good too. There's a lot of, again, tax benefits.
And I think one of the constraints people have seen over time is, okay, I'm an ESOP, and maybe I guess one thing we've not touched on is, in terms of future risk planning, is the repurchase obligations of ESOPs. So as you get deeper into the life of an ESOP and people retire, right, when they have these significant life-changing balances, you've got to pay those, right? So that cash, the management of repurchase obligations and the cash planning and debt planning obligations are really significant. You're both nodding. Anybody want to spend some time on that one?
They are significant, but they're known, right? A good distribution policy will help insulate the company itself and the plan from a run on cash. A poorly, again, all about the design. We had owners that thought a live situation where an owner thought, hey, this is all about the employees. I want to do good for the employees. And so, they had a very lenient distribution plan. And one of the employees called in rich and took his ESOP balance and went and bought a Ford F-150. And next week pulled into the parking lot. And wouldn't you know it, 11 other people wanted an F-150 and quit to get to their balance. So, a good distribution policy helps. And then, yes, it's a known obligation. And so the company just needs to start funding for that. And there's all kinds of neat solutions that can be put in place to help with that funding. But you want to set that, you don't want to just neglect it. You need to eventually start setting dollars aside, because in the studies, the future repurchase obligation studies that are done when we put these in place, it shows the things like Gail and Chris talked about of diversification and when those are going to hit. And so these are known obligations. You just have to fund for them. That's all.
And pretty much every board meeting that I'm at, we're looking at a 25-year projection of the cash flow required to buy out people who are retiring. And the mental model I like to use on it is, if the employees at the beginning leveraged to buy the company from the original owners, at some point the new employees have to leverage the company to buy out from the original employees. Right. So it is kind of an ongoing equity transaction. And I think that's a healthy way to look at it in planning forward.
Yeah.
And I think I'd be interested, Carrie, Chris, in both of your experiences with this, the dynamic of the Tale of Two Sisters, the employee who's there at the beginning and really has so much upside from it, and how do you see it play forward? Is it something where future hires are sort of protected as well, or is there sort of a have not kind of dynamic that you sometimes see? I'd be interested in your,
in terms of the original owners having
yes,
bigger,
the original
employee,
yes,
having
the
a
original
much bigger
participants,
stake.
versus later employee hires.
In my experience, certainly things cum up over time, right? So employees who've been there for a long time, definitely have more of a stake, but it does go to plan structure and to make sure that there's enough for future employees. One of the interesting things that I went through as a director was I was involved with one where, in fact, a lot had been allocated to the original employees, and the way the allocation process had been set up, there was going to be a point when exactly that happened. There was going to be like nothing for the future employees. And interestingly, the trustees, who are supposed to be interested in the employees only, were able in that case to take into consideration not just today's employees and yesterday's employees, but tomorrow's employees. Yes. So they were able to take the long view of, if this is going to survive and benefit future employees as well as past employees, we're able to renegotiate the way the loan worked and just smooth it more over time, so that all the benefits didn't go to only the people who were there today. I don't care.
Yeah, I think that's a good point. And it goes back to, giving everybody a one-size pair of jeans. It's not one size fits all, right? So the design is critical. And what we're talking about here can get into a design of recycling the stock versus redeeming the stock. And yeah, it's tough when you have these ESOPs that are in place for a long period of time, where all the stock's been given out and future employees don't get the benefit. Again, it goes back to the design. What are we doing here? A lot of ESOPs are not permanent. I mean, ESOPs get taken out all the time. ESOPs are great targets for companies. Chris, you mentioned that early on. So a lot of ESOP companies do get taken out, but also a lot of ESOP companies can buy other companies. Because they have this internal stock market where they can go out and acquire targets. And a lot of times ESOP companies, when the design is structured correctly, they can acquire targets for 50% less than what they would have had to acquire them for. So again, it goes all back to design. You can design them where the stock redeems, and then the board can always pull stock back out of Treasury and replicate the transaction. We have examples of companies that are under third generation family companies where they move with a proper design, are able to move from one generation to the next in the family using an ESOP structure. So again, so many different ways to do it.
Yeah, thanks. And we did one last question around, so if you are an ESOP and want to exit, is that, if you want to sell an ESOP, is that hard?
Not if it's done correctly, right? I mean, sometimes you have owners that try to abuse these things, and the trustee's not going to allow that to happen. If it's good, it needs to be good for everybody. It needs to be good for the employees that own the stock. I mean, if they're going to be taken out and it's going to be a huge win for them, yeah, the trustee's going to approve that. And ESOP companies are targets. They're fully vetted. They have to have annual audits and valuations and stuff, so people know what they're buying when they're buying an ESOP company. So they are targets.
So as we're going here into wrap up, I guess I'd ask quickly if both of you want to make just a quick comment or takeaway that you'd like to leave our audience with, and then maybe I'll do some right at the end. Gail, do you have final thoughts?
Yeah, I'll go first. Just to let Carrie have you and Carrie have the last word. But I think that just from what I would like to say from my practice in this area, from a legal perspective, is you really want to get good advice. You want to know what the responsibilities are, and you really, as a director, or even in selecting a trustee and in deciding how to go with evaluations, you really want to have a very robust process that you document so that you don't have, as the saying goes in ERISA, you don't have to be right, you just have to be prudent. And the way to show that you're prudent is to set up a robust process and document what you did.
Thanks, Gail. Carrie?
I agree with Gail. I mean, look, ESOPs, my comments is ESOPs should always be put on the menu. They're wonderful, wonderful vehicles to transition and exit a business. As we said, not everybody should do it, but it should be at least put on the menu as an option. And then just beware. If you're already part of an ESOP, I think there's a lot of good comments about governance and all that. But if you're, as some of the folks had said, they're looking at possibly becoming an ESOP company, buyer beware. This is not a product sale. This is an M&A transaction, and it's very, very important. It's easy to sell these things. Don't buy the sizzle. Don't let somebody tell you all the sizzle, and because boy, there's a lot of sizzle there. Don't buy the sizzle. Do your homework. Talk to multiple folks, and because what you don't want is the suits riding into town, having you established it now as an ESOP company, and the suits ride out of town, and now you're stuck with this thing that's a poor design, and you got to live with it. It can bankrupt your company. So beware. They're wonderful, but they got to be done right.
I think Carrie said it to us in the pre-work by saying, you don't want to have to say your baby is ugly. You want to be able to say It's a beautiful baby. You now have this new ESOP and you can grow and thrive with it. I guess my final thought on this is reflecting back on why do I enjoy serving on ESOP boards? And in part, my perspective as an executive for years and as a director is that employees, in fact, are the greatest asset of any company. And there's something about serving an ESOP where it's explicit, right? People acknowledge, people talk about employees, even if we're technically participants, we talk about them as owners, we treat them as owners, we respect and listen to them as owners. And so you can go into that world and that's a fundamental, a given, as opposed to something you have to debate. And there's a delight in that, right? And I think there's a power that you see in the turnover numbers and the success of some of the ESOPs because they've tapped into that employee engagement. So all of the things we've talked about in terms of considerations and complexity, you should be aware of all of it. But there's a lot of joy in ESOPs and a lot of power. And I guess I would leave you with just a little note that today we were reading in the front page of the Financial Times on the way over here that CalSTRS just came out and was really challenging private equity to say, you need to give more of your wealth to your employees. And that's a powerful tool that all of private equity is missing. Maybe, with the KKR industrial group set off to one side of that, but there's a lot of power in it that I think as the world is recognizing it, this is going to be a more and more important tool for more and more companies to thrive.